Right. Good afternoon, everybody. Thank you for joining us for our eighth board training webinar of the year. I am Jocelyn Gusta, and I am the Client Relations and Marketing Coordinator for the firm. And I am a great resource to provide you information about our classes, articles, and blogs. And you can reach me at jocelyn@nowatcoward.com. Please also know we welcome your comments and your feedback at any time regarding our classes or anything else. And you can send those to me or at academy@nowatcoward.com. It is our privilege and our pleasure to provide support to such an incredible group of volunteer leaders. And we are so grateful that you have entrusted us to advise you and help lead your community. So I am here today with one of our founding partners, George Nowak, and our senior partner, Bill Gurley, who will be leading today's program to dive deep into insurance coverage. Regarding today's class, I will send a follow-up email by the end of this week with today's course materials. And you can please note that we only provide general information throughout this webinar format. So if you have any specific questions and need any legal advice about your community or your association documents, please reach out to me or your general servicing or collections attorney in the firm to provide that specific legal advice. We will also take general questions throughout our program, so please feel free to ask your questions through the Q&A feature. We will do our best to get to as many of them as possible as time permits, but again, please feel free to reach out to our team for specific legal advice. So with that being said, please enjoy the program.
Good afternoon, everyone. I'm Bill Gurley, and I'm here with George Nowak. Welcome to the SEC Football Preview Show. The lines are open. Call in with your questions and predictions. I'm kidding. We're here to talk today about an equally important topic, Insurance 101 for community associations. This is a class that I love to teach with George because he literally wrote the CAU insurance policy for community associations. So when all his friends were out fly fishing and playing golf, he was in the basement writing an insurance policy, and that policy is still used today in various forms. And George has also been involved on the national level with various task forces for decades on the issue of community association insurance. So like you, I'm always going to learn something new when I present with George. Um, Before George looks at some of these policies in detail, let's start out with what insurance is required for community associations in Georgia. Well, it's going to be whatever your governing documents say your association has to have. So you're going to look at your declaration, your bylaws, maybe even your articles of incorporation, and see what type of coverage do those governing documents mandate. Second, if you're a condominium, then in Georgia, there are specific statutory requirements for property and liability insurance under 44-3-107 of the Condominium Act. And George is going to talk a little bit more about that in a minute. But that's it. There are no other Georgia or federal laws that mandate any type of insurance coverage for community associations in Georgia. However, as a firm, we strongly recommend comprehensive coverage, and we're going to go into what those policies look like. In addition, we do want to note that Fannie Mae and Freddie Mac, as a part of their underwriting guidelines, do have specific coverage requirements if loans are going to be made for the property. So with that, let's look at what are the coverages that Nowak Howard, that Bill and George recommend for all associations, regardless of what the law requires. Number one, a property policy. Number two, general liability policy. Number three, very important, directors and officers, or D&O insurance. Number four, crime, also referred to as employee dishonesty insurance. And this is a different policy than the ones your management company may have if you're professionally managed. This is the association's own crime/employee dishonesty policy. we recommend a separate policy typically than what would be perhaps included in one of your package policies to give you more broader coverage, higher limits. Number five, this is a newer type of policy, but becoming increasingly important, and that's cyber liability. Those policies look different depending on which carrier you use, but you want one that provides comprehensive coverage for things like data breaches, cyber crimes, and hacking, malware, etc. Number six, workers' compensation. And I know some of you are probably thinking, well, do I need it if I don't have any employees? Yes, you do, for two reasons. One is it's going to cover your volunteers that are doing work for the association. Like, for example, if somebody is setting up tables in the clubhouse to prepare for a meeting and they're injured, this would typically provide coverage in that situation. The other situation is if you hire someone that's supposed to have their own workers' compensation insurance and it turns out that they don't, and a claim is made and the association is brought into that, then and hopefully there's coverage under that policy. So workers' compensation policy, even if you don't have any indirect employees. If you do have direct employees, we also recommend an employment practices liability policy. And then finally, an umbrella or excess liability policy is really what we would consider mandatory this day and age. That's an additional layer of insurance that's going to kick in after your primary policies to give you more coverage, higher limits. Used to be very cheap, relatively speaking, has increased cost-wise in the recent years, like everything else, but still very affordable given the additional coverage that you're able to buy with that. So, for example, let's say your liability policy gives you $1 or $2 million in coverage. Well, you can get an umbrella to add on top of that, $3, $5, $7, $10 million, whatever it may be, of additional coverage. So 1 through 8 on the left side, these are what we would consider as our firm to be mandatory policies for every association, regardless of what your governing documents require. Also want to make you aware of some other policies that are becoming more common and maybe helpful to you. A flood policy, that can be helpful when there's not only what you might traditionally think of, maybe a stream overflowing, but when there is a massive rain or storm event, there can sometimes be coverage in that case for water that enters property that may not be covered by your property policy. We had that with one of our clients where there was, a water event and water got in. It was denied under the property policy, but a claim was made under the flood policy, and they were able to look and see that yes, there was a massive extreme rain event that day, and there was coverage under the flood policy. Second one, we are in an active earthquake zone, so to speak, and so there is earthquake coverage available. Again, the cost is relatively inexpensive for what you get. Social host liability coverage or liquor coverage if you're going to be hosting events, especially if there's alcohol being served. And then finally, organized sports. If you have Alta tennis, if you have swim leagues, if you have swim lessons, if you have a local scout group using your facilities or a local school using your facilities, whatever it is, we recommend this organized sports coverage. It goes by different names depending on the carrier. Sometimes there is some coverage in your liability policy, but reach out to your agent for more information on that. George, did I miss anything on the basics, the background policies that you might want to add before I move on?
I'd add on liquor liability and organized sports that one, make sure you have the coverage, as you just said. But in breaking it down, host liquor liability, many liability policies have it in their standard policy. But what we recommend to our associations, if the association is going to have a gathering, whether the association provides the liquor or not, that you let your agent know that, hey, we're having this and it's either bring your own or we will be providing whatever the facts are. And just say, I'm just confirming that we have coverage. Something as simple as that. You have coverage if you're not in the business of manufacturing, selling, or distributing alcohol, but it never hurts to give them advance notice. And the same thing with
In
organized.
writing, in an email.
Yeah,
And
email. I mean, you want to. I said call. That shows my age. You want to email them and confirm they got it. And then with organized sports, that is a huge surprise to most of our associations, as you said, who have swim leagues, ALTA, et cetera, et cetera, et cetera. So if you have a professional, if you have someone who runs your tennis program, you need to be careful on that also as to whether or not you have coverage for organized sports, but more importantly, whether he or she has coverage for things that can go wrong while they're teaching lessons.
You're right. And we want both. We want to mandate that whoever's running the program has their own coverage.
Mm-hmm.
And then we want ours, just like with the crime policy.
Yeah.
And why this is so important is all it takes is one allegation. He or she, from say a child's getting swim lessons, he or she did something inappropriate. I mean, that right there is enough for the association to potentially have some exposure, and you want insurance to at least be providing a defense, paying your attorney's fees in that situation.
Exactly.
So very important.
And we do have a question before you
Sure.
move on. We've actually had a few questions come in, but I'll start with the first one. If our HOA, POA, and COA declarations allow the board to appoint a qualified individual to chair the Architectural Control Committee, does qualified require professional expertise, or can it be any non-owner or non-board member? Also, can the ACC consist entirely of non-board members? And how does that affect board liability and D&O protections when committee decisions impact structural, electoral, or plumbing matters?
Well, great questions. A lot of them are beyond today's class, since we only have a limited amount of time, and probably are more specific to that particular community. So, email and happy to address that with our clients directly. But on the issue of D&O, and we'll talk about this later, we want to make sure the carrier knows and that we have an architectural control committee, that it has volunteer members that may not be on the board, that may not even be a part of the community, so that we can make sure that they are insureds and covered under the policy.
Mm-hmm.
Okay.
George, do you have anything else to add on that, or?
Nope.
Okay.
And another quick question. I have trouble finding an insurance company that understands this type of insurance for HOAs. Is there a list of insurance companies or brokers to whom I could reach out?
Another great question. And one of my last tips you'll see at the very end is don't buy insurance from auto insurance
Carriers.
So what we would refer you to is the CAI Georgia website has a directory, a member directory, that lists insurance agencies and brokers that specialize in community association insurance. There's several of them in the state. And we can send you that. I'll make a note of it right now. If you could just get the name for me, Jocelyn,
Sure.
of the insurance brokers, and we can send that out.
Okay, and lastly, do we need coverage if we rent the pool out for parties but do not allow alcohol?
Yes,
The answer is yes.
yes.
Yes. Um, you want to make sure, again, no, in discussions with your agent, um, well, there's so many things that go into this, but from the insurance standpoint, you want to make sure that your agent knows that you're making money by renting your clubhouse to someone. Where it gets more complicated is if the someone is a member of your association or if the someone who doesn't live in your association. And there are Fair Housing Act implications and requirements to comply with handicap access requirements if you are allowing people who do not live in the community to use your facilities. But you definitely want to just confirm that if you're renting the clubhouse, that your coverage will stay in effect.
I'm going to confirm that in writing. And yes, you want the policies that we've had listed, including the property, the general liability, the D&O, the workers' comp, the umbrella, the organized sports or organized activity, the social host. We want all of that. And we want the carrier to know in writing, this is the type of activity that we're allowing. Uh, and please confirm that it's not going to jeopardize our coverage.
Exactly.
All right. So we talked about what we recommend for associations. What about the homeowners? Well, they need their own.
Hey, Bill, before you go any further, let's make clear the difference between condominium associations and homeowner associations, POAA, submitted primarily subdivisions. Most of what we're talking about from this point forward is really more specific to condominium associations. Not all of it, and we'll make that clear. So when Bill is now going to be talking about homeowners insurance, the HO6 policy, he's not talking about insurance for individual homes within subdivisions that are not subject to the Georgia Condominium Act. This ties into what Bill has already said. The Condominium Act in Section 107 has certain requirements for the association, and Bill's now going to talk about what you as an individual with the condominium, what we recommend you should carry individually.
Good point, George. I mean, I think regardless if you're a condominium unit or a lot in a HOA, a townhome, whatever it is, you want to have a homeowner's policy.
Right.
Okay. If you are in a condominium, that policy is going to be called an HO6 policy. Okay. And you're going to want to have some different additional coverage than your standard homeowner's policy for, that's in a detached single family dwelling in a common law HOA. So that's what we're going to look at right here. The HO6 policy is going to want to cover the dwelling to the extent not covered by the association's master policy, needs to cover any upgrades or betterments in the unit. So if the unit came with carpet originally and that carpet's been replaced with an upgraded flooring like hardwood flooring, your HO6 policy needs to cover that. The deductible that you would be responsible for, your personal property in the unit, any liability for any incidents that occur in the unit where somebody is injured. If you're engaged in short-term rental or any business activity, you need coverage for that. And any loss of use of the unit. If there's let's say a water event and you're not able to use the unit for a period of time, you would want some coverage for that. I'm not going to get into too much more right now on the HO6, but those are the general types of coverages you would want to see in that HO6 policy. From my standpoint, I think it's important to always give or make available to the homeowners copies of the association's master policy so that their broker can look at the policy and see what the coverages are, what the gaps are, for example, what the deductible amount is, and then craft the HO6 policy based on that. All right. So what's going on in the insurance world now? What are the trends? And this is something that George and I talk about a lot lately, and some of these are not going to be news to you. Number one, skyrocketing premiums. Insurers are passing on the increased cost of their reinsurance premiums to the associations. Reinsurance being the insurance that insurance companies buy to limit their exposure. Okay. And the regulators allow them to pass on that cost because the regulators say, well, that means they're staying in the business. So we want them to be able to pass that on. These increased premiums and reinsurance premiums are really being driven by, the pipe breaks that we experienced, wind and hail events, hurricanes. But the good news is knock on wood, it has been a relatively modest hurricane season so far. When that happens, there's obviously less loss. There's also less demand from these insurance companies and from sovereign nations for reinsurance policies. So you have a market of reinsurance where the supply is growing and they want to sell. That's how they make money, is selling these policies. When that supply grows and there aren't losses, then we hope that the premiums will at least stabilize or maybe come down. And if the reinsurance premiums go down, then hopefully your insurance premiums go down or at least don't go up. So we have skyrocketing premiums. We have a lot more deductible buy down policies. You may have heard about these. These are secondary insurance policies, additional insurance policies that associations are buying or adding on through an endorsement to buy down the deductible amount. And so the primary policy would pay first, and then the secondary policy would kick in. And the theory is then you're not hit with a major cash event all of a sudden, and you've bought this additional protection and spread that cost out over time. There's also been a shift to the E&S market. That's the excess and surplus market. In this market, we have higher rates and we have fewer protections. You may have heard of Lloyd's of London. That's a big player in the E&S market. These are insurers that are non-admitted carriers, which means they are not subject to the state. They're licensed to sell in the state, but they're not going to be subject to the same form requirements and rate requirements that the traditional carriers are. They are also not backstopped. They're not guaranteed by the state in the event that they go bankrupt. So they have the flexibility to sell in the state. They can craft more unique coverage, and they're an available product. That's the pro when you don't have choices in the traditional market. The downside being that it's going to be more expensive, fewer protections. If they go bankrupt because of major losses, the government's not stepping in to backstop them. We're seeing tighter underwriting requirements, both from the traditional carriers and in the E&S market. Their carriers are really becoming more selective with their underwriting. They're requiring more maintenance. So they may say, we'll write a policy subject to you replacing the roof, replacing the electrical panels, doing some foundation work, replacing piping. And they're sending inspectors, engineers on site more often now to look at the physical condition of the property. They're also using satellite imaging, drones, etc. And then they're giving very short turnaround time periods in order to keep the coverage. So they may say, we're writing this policy. It's in effect now, but if you don't replace the roof in 30 days, then we're canceling the policy. And of course, you were like, well, we weren't planning on replacing the roof yet. We don't have the funds. They can't come here quick enough. But this is what's being required. Some will work with you if they see that you're taking reasonable steps. Others are very tight on these timelines. We're also seeing higher deductibles, hence why we have these deductible buy down policies, especially for wind and hail cover damage. They're getting their own higher deductibles. We're seeing more exclusions. Like policies are outright excluding coverage for assault and battery. They might exclude coverage for anything that had to do with firearms, anything that had to do with animal attacks, any sort of sexual molestation. They're carving out the problem claims and saying we're not going to cover those just right off the bat. And then we're also seeing a lot more denied claims due to late reporting. There's this trend where associations were not putting carriers on notice of claims because of the fear, and rightfully so, that it may affect the ability to get coverage or increase premiums. A legitimate concern. But what happened is then when the threat or the allegation then becomes a lawsuit several months down the road, well, the carrier's saying you didn't timely report this, so there's no coverage. And we're seeing that a lot more today. George?
And Bill, that goes to, well, when is a claim a claim?
Err on the side of caution.
If the person stands up at the annual meeting and says, I'm going to sue you, don't look at it and say, well, George always does that. He never follows through. Yeah.
If it's a direct threat or an insinuation, you got to report it. That's our advice.
The board gets a letter from an attorney. And the classic thing that, govern yourself accordingly. That just is fingernails on a blackboard to me. But you got to err on the side of reporting, as you're saying, or else the downside is what you just said.
Yep. And these are what we need to stress is that even claims that really lack merit and that the homeowner may not ultimately prevail in them, well, unfortunately, those take 6, 9, 12, 18, 24 months to resolve, all the while you're incurring attorney's fees to defend against them and get it dismissed. So while you might not have any liability, ultimately, you have a huge attorney's fee bill. And if you haven't reported the claim and gotten coverage, you are going to be the one absorbing that cost.
Mm-hmm.
And it's the classic, you didn't think that someone was serious and they turn out they are. Then you have to explain to the owners, well, they told you were going to sue. Why didn't you report it? Well, we didn't think they were going to do it. So err on the side of caution. All right.
Okay, before you move forward, we do have a few questions in the chat.
Okay.
First question, if the master policy has a $10,000 per unit deductible for water damage, is that the amount the homeowner needs to cover with their own HO6 policy? In other words, is that the gap the homeowner is responsible for insuring?
Well, they're never responsible for insuring it. They're responsible for paying it. So let's clarify that, going back to what you must have. But that's the answer also. If you do not have an HO6 policy that includes coverage for a deductible assigned to you, then you're coming right out of pocket with your own money, as opposed to your carrier paying for that deductible amount.
Yep. So the homeowner should get the coverage for that amount.
But they're not required. I mean, let's be clear.
Okay. Second question, does Betterment's coverage include anything done to the unit after it was sold from the developer to the purchaser, or only the original developer installed finishes?
It would be improvements and upgrades after the original construction and sale of the unit for the first time. And the key would be that the homeowner needs to make sure that their carrier, their HO6 carrier, knows what those improvements are and what, we can look back at that, but informing them of what's in the unit and what was upgraded from the original construction.
But I'm the sixth owner, Bill. I have no idea what was original and what's been added. So I'm just going to say it is the way it is when I bought it.
Yeah.
So from a coverage standpoint, the insurers, they know how it was built. There's either still a unit out there that's original that everybody knows about, or they go back to just builder's grade construction for the time period. And so when you have an HO6 policy, the insurer, the HO6 insurer, is insuring the property in the condition it is when you buy it. It's been upgraded. It's got travertine or whatever the material of choice is these days. It's got sub-zero appliances as opposed to Frigidaire. And so the HO6 carriers write the premium base to put it back to the condition it's in when it's damaged, to the extent it's not covered by the association's policy. So the difference here is the association's policy, with adjustments for inflation and changes in materials and all those things, will pay to put the unit back to the condition it was in when it was first sold. The difference then between that and the condition it is in at the time of the loss is what's covered by the HO6 policy with betterments and improvements.
Yep.
Okay. And lastly, can you comment on what percentage increase in premiums we should anticipate for 2027, factoring in SB 406?
No.
No. Next question.
Great question, but don't know the answer. Let's take a look at this poll question, because George and I, on the issue of premiums, we want to know, has your association's insurance premium increased in the last year? So let's launch that poll. We don't have to have exact science, but let's give everybody some general idea of your association circumstances. Jocelyn, you able to launch that? There we go. All right, real quick. All right. Show us the results, please. Okay. 5 to 10%, 25%. Okay. Not terrible considering that, of course, we hear the worst news, but we're very aware of clients that have had 100% increases with very little notice. So happy to see those results. With that, George, what's the good news?
If you have insurance, keep it. I mean, the market is a tough market for all the reasons that you just explained. Going out into the market is not something that you really want to be doing at this time. If you're forced to go into the market, Bill just talked about huge increases. We had a client whose premium went from 400,000 to 1.4 million in one cycle, and the agent worked as hard as he or she could, and they had 48 hours to accept it or not. And if they didn't accept it within 48 hours, that was the date that their policy expired. So if you have it, keep it. Yeah, the price is going to go up, but realize keeping it in place and showing that you're loyal to the carrier, it does help you, because carriers look at how many times you switch policies. So if you got it, the good news is keep it.
But what's the bad news?
Well, the bad news, if you've been canceled, you first of all do your best to get it. But the next thing is, if in a condominium, because you have to insure the property, you have to notify all of your owners immediately that, hey, effective X date, the association's insurance policy will expire. We are working as hard as we can, blah, 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 to get it. But in the meantime, if there's a fire or other casualty to the building, the association's insurance will not cover it because it is not in effect. I've had to do that twice. One time the board didn't even know their policy hadn't been renewed. And the other time was they knew and they sent the letter out.
Wow.
And then they started hearing from the mortgage companies because the mortgage companies rely on the association having the insurance to put the building back to the condition it was in when it was first built. They eventually got coverage in both situations, but think about the board of directors having to send out that email, write that letter, and really knocking on wood. Thank God there was no casualty of any sort that occurred when that insurance, they just didn't have it.
So going from 400,000 to $1.4 million premium, that's really the ugly news, because you got to figure out how to pay that, right?
You do, and your insurance renewal premium and your budget cycle probably don't mesh. So that's the first thing. You're in the middle of the year and you get this notice and you have to come up with the money. So where do you look? Well, special assessments. If you have a need for immediate money, then the Georgia Condominium Act allows the board of directors to impose a special assessment of 1/6 of the annual assessment without a vote of the members. And there is no provision in the Georgia Condominium Act that says the number of days that you must give people to pay. So there's a special assessment, but it's limited to 1/6 of the annual assessment. Reserves. Reserves is always
I'll just add,
response.
George, if it's going to be more than that 1/6 amount, then you're going to have to get the membership approval.
You have to get a vote of the approval of the membership, which under the statute is the majority of the members. So,
okay.
And it takes a vote, and you have to give notice. You have to follow the procedure to pass a special assessment with this.
Right.
Wow, quick timeline. Reserves, unless your documents specifically prohibit how reserves are spent, then that's how most associations would pay for it, especially a mid-year, not budget cycle centered increase in premium. Finance. This may sound really odd, but this happened. We had an association whose insurance policy was set to expire in December. Their annual meeting was in December, and they got this notice, and the board didn't want to go back and redo the budget, and the board couldn't use money from reserves. So they came up with the idea, which agents tell you, well, you can finance it. And the issue there was signing an agreement to pay whatever the percentage was for the payment of the premium, whether that constituted borrowing. And many of the association's documents limit borrowing, either flat out prohibit it, say you can borrow up to a certain amount without a vote of the members, or you have to get the vote of the members. Well, in this association, they were required to get a vote of the members. And the whole issue boiled down to, was financing borrowing? And I got to tell you, the answer is maybe.
Yeah. I'm seeing a lot more.
Went ahead and financed it.
Yeah. I'm seeing a lot more of these. In fact, there is a company that's headquartered in Georgia that specializes in this, and we'll see where the industry goes on that.
Yeah, but they had a person who was making a big deal out of it, and the homeowner obviously said, so what you're saying is we should go without insurance until we can get a vote, because we have to give 30 days notice before we can vote on borrowing. And his response was, yeah. And the board
said, there's always that guy.
We're going to do it and sue us.
Yeah. Wanted to share with you on this next slide this great article that George always points to about insurance risk management. You can click to read that article at your leisure. Wanted to make you aware of it. There's a couple more articles throughout our presentation that we've linked to just for your reference.
Now we're going to get into the specific coverages that Bill talked about on the required and or encouraged. We'll start with property. The Georgia Condominium Act requires the association to carry insurance to replace the property to the condition it was in when it was first purchased by the unit owner or first constructed by the developer. Bill mentioned Fannie Mae and underwriting guidelines. I'm going to get into that in a little bit. So what you have, to recap, is you have the duty under your documents. If you're a condominium, you have the duty under the Condominium Act. And from a financing standpoint, you have to comply with the Fannie Mae and Freddie Mac insurance underwriting guidelines. As Bill said, the condominium policy that the association purchases is generally referred to as the master policy.
And George, even though we're going into some detail on condos, keep in mind, even if you're a common law HOA, you probably have clubhouse, entrance monument,
Sure.
detention pond, streets, other property that needs to be insured. It's either property you own or you're contractually required to maintain.
And the thing, and this, as I said earlier, a lot of this applies to your clubhouse, to the property that the HOA or POA owns. Obviously, it doesn't apply to lots, as we said, where in a condominium, it does apply to units. So the Georgia Condominium Act, Section 107, in that article that Bill just showed, that magazine, this is all explained, and I'm not going to spend any more time on this, other than you can see the highlighted words that says that the policies must afford fire and extended coverage insurance. And fire and extended coverage insurance is the minimum that the association's policy must cover. And if you go down to the 5th bullet point there, no,
on this one,
where you were, Bill.
There we go.
Covered perils are fire and extended coverage. It's fire, windstorm, hail, riot, civil commotion, automobile, aircraft, explosion, and lightning coverage. So if you look at that, that's saying if you have a fire, you have windstorm, hail, those things. And automobile means if an automobile crashes into your structure, if an aircraft comes into your structure.
It's happening more often.
It happens. And lightning coverage. What you don't see there is the requirement that an association carry water damage coverage. It's not required by the Act. But let's be honest, folks. A broken pipe never happens on the first floor. It just never happens on the first floor. It's somewhere way up in the building. And we all know that water doesn't run uphill. And it runs downhill. And you're sitting in your unit and suddenly you're inundated. You're flooded with water from a broken pipe, a washing machine that overflows, a bathtub that overflows, all of the things that we know how water damage, the source of water damage. But the law, the Georgia Condominium Act, does not require the association to carry that coverage. Go ahead, Bill.
But you should have it. And
well, you're going to talk about that later, but yeah, come on, let's be realistic. If you are in a high-rise building and the association does not have water damage coverage, well then, the common elements, if they're damaged by water, you will pay for it through a special assessment or some other way of paying for that. If you're an individual owner and the association doesn't have water damage coverage, then you better make sure that your HO6 policy has water damage coverage. The result of both of those, if there is no coverage, then the responsible party is coming out of their pocket to pay for the damage. I'm an owner. I don't have $25,000 to fix my unit. I don't have a whole lot of equity in it. I'm out of here. Same thing with the association. Well, the swimming pool, the pump house, those things have been damaged. We don't have the money right now. So stay tuned, but until further notice, the swimming pool et cetera, will not be operational. So it's important. Other things, ordinance or law coverage. Most cities have a requirement that if more than 50% or 40% or 60% of a building is damaged, then the remaining property that's not damaged has to be torn down. So if you look at a property policy, part of the building had fire damage. The rest of the building didn't, but the percentage of loss exceeds the minimum or maximum where you can rebuild. If you don't have ordinance or law coverage, then there is no insurance to tear down the undamaged property and to put it back. So we want the association to have ordinance or law coverage. Next, demolition and debris removal. You got to take it out before you can put it back. And demolition and debris removal is included in most policies, but the question there always is, how much is enough? And you want to talk to your agent about that. If you know that you are an older building that has asbestos in the building, it's expensive to abate asbestos. And you want to make sure that you have coverage to the extent it's available. Increased costs of construction. Aside from, what do you mean you don't pay to tear down a perfectly good part of the building because the city says you have to? When you build, you're building to current code. It's 20 years later and the building code has changed. The policy that you have will pay to put the unit back to the condition it was in when it was originally built, as we have said any number of times. You can't put it back to the condition it was in when it was originally built because the code has changed. Increased cost of construction covers the difference between those two sums. Flood. Bill already mentioned flood insurance. It used to be you could buy flood insurance right up to the time the storm hit you. That scam went away a number of years ago, where if you're going to get in flood insurance, it has to be in effect for at least 30 days before there's coverage. And windstorm. Windstorm is a big issue with insurance companies. So many of the lawsuits out of Hurricane Katrina was whether or not it was water, it was the hurricane, or it was wind-driven rain. But you want to make sure that these are coverages within your property insurance that your master policy has. Common policy exclusions, and we're just going to
some of this is review, but
yeah, personal property. The association's not going to insure your personal property. Betterments and improvements, personal liability. Someone gets hurt, slips and falls inside your unit. Water damage, flooding, earthquakes, construction defects. We haven't mentioned that yet. Builder builds a bad product. There are construction defects. There is no insurance for condominium associations that pays for construction defects. Maintenance, wear, and tear. That's another one that surprises people. If the roof leaks because of wear and tear, as opposed to lightning hitting it or a branch falling on it, the leak is still a leak and it's still causing damage. But if it's because of wear and tear, there is no coverage. Right. And practically that makes sense, because if you had coverage for wear and tear, you'd never afford the policy because everything eventually wears out. Sewer backups. Want to make sure that the master policy has coverage for the damage that a sewer backup causes. And if the association within the building has short-term rental and business activity, just making sure that the insurer knows about it.
Okay. Who's paying the deductible, George?
Who pays the deductible? Well, you always have to look at your governing documents to see if it addresses it. If it doesn't address it, it's covered by Section 93 of the Georgia Condominium Act. One of the things that we see, because of the ages of properties now and what the document said back then, was applying the deductible. Right now, the deductible for perils of fire and extended, fire, windstorm, hail, riot, etc., the maximum deductible that can be assessed to a unit owner for one of those perils is $5,000. That's the maximum, not water damage. And we'll talk about that. A lot of our clients, because of an affordability issue, are having the general deductible, the basic deductible, in excess of $5,000, because the higher the deductible, the lower your premium is, because the insurer doesn't pay until the loss exceeds that deductible. So you have a fire and the association has a $10,000 deductible for fire damage. The most the association can charge back to a unit owner is $5,000. That difference between the 5 and the 10 is a common expense that has to be paid for by the association. And as deductibles go higher and associations opt for these higher deductibles, one of the things that Fannie Mae has in its requirements is, if you're going to play that game, and I don't mean that in a negative way, it's an economic decision, but you have to, in essence, budget for what you anticipate the number of differences between what you can charge to the owner is and what the association has to cover. For water damage, there is no limit on the assessment of the deductible amount. Most associations have $20,000 deductibles at this point, but we have associations, high-rise associations, and some garden-style buildings, where the deductible per unit per water damage is $100,000. More commonly, we're seeing $50,000. But going back to the question that we've answered, whatever the water damage deductible is, it is the responsibility of the owner of the damaged unit or the association when it comes to the common property. That's why it's critical that an HO6 policy includes water damage coverage and or loss assessment deductible insurance. Because initially, if you get hit with a $25,000 water damage deductible, you're going to submit it as a claim for deductible reimbursement to you. But if it's not covered, or if it's not enough, under an HO6, if you have water damage coverage, you also have the right to make a claim for the water damage to your unit, which equates to the deductible that is assessed to you. So as individual owners, as board members with your individual units, you really want to make sure you know what the water damage deductible is by the association. And at a minimum, you want to have coverage that covers that deductible. Otherwise, you're out of pocket.
So, George, just real quick to review, so we make sure that everybody gets this right. One of the most common losses in a condominium is, let's say, a sudden and accidental pipe break, i.e. water damage. But
right.
That type of peril is not covered or is not required by the Georgia Condominium Act. So you don't have to buy insurance for that. But you should, because that type of loss is very common and very costly. So if you do buy it, you're likely to have a fairly high deductible because there's so many water claims and you want to keep your premium down. And therefore, and unlike the other perils that are required by law to be covered by law, you can assess the full amount of that deductible to the homeowner. So therefore,
that's correct.
They should know whether or not you have water damage coverage to begin with, and if you do, what the deductible amount is, so that they can get coverage for it in their HO6 policy, or if you don't have that coverage, so they can plan, accordingly.
Correct.
Okay.
Yes, it's critical, and the issue of coverage requirement under the Condominium Act for water damage reached a head, let's call it, several years ago, and we were able to get into the legislation. There is a flat out statement now in the Georgia Condominium Act that an association is not required to carry water damage coverage. All right.
We do have a
Financing.
quick question. Sorry to
Sure.
interrupt.
Sure.
Yeah.
Does the $5,000 maximum deductible to the owner you mentioned for condos also apply to a POA governing row house that are not legally condos?
No.
No.
Whatever the deductible is needs to be addressed in the documents, as Bill said at the beginning. And if the POA documents, your homeowner association documents, do not address the deductible, then the only thing that a board can do if they're not going to do an amendment that assigns it is to pass a resolution saying this is how it's going to be applied. But no, none of the things that we're talking about limits on the deductible or the amount of deductible, applies to an HOA only to condominium units.
So
Okay.
does the HOA have to ensure that all homeowners have adequate insurance?
No. Well, again,
It's in our interest.
yeah, let's make sure we're talking. The question talks about an HOA. Generally speaking, the HOA documents have no requirement about anything about insurance about the individual lot owners or the individual homeowners. You mentioned in the question that it's a townhome, so you've got attached walls. The only requirement that could exist is if the documents themselves required each of the townhome unit owners to have insurance. That then gets into, well, how does the association know they have it? Can we demand that they give us a copy of the policy? What if they don't have it? Can we purchase it? And those questions are answered with, yes, if you don't have it, it's a violation of the covenants. Do you have the right to demand they get it? You could, but the problem with that is a practical problem, is you have to monitor everybody's house every year and know their dates for the renewal. And what association wants to take on that responsibility? So we can't force people to do it. Same thing in a condominium. We can't force them to have an HO6 policy.
All right, George.
Yeah.
Why don't you go through these Freddie Mac, Fannie Mae underwriting guideline requirements real
Okay.
quick?
Let's go. We haven't used the term full replacement cost coverage without calling it that, but that's what we've been saying, where you have to put it back to the condition it was in when it was originally purchased. Full replacement cost says you have a 10-year-old refrigerator. You have to get, the insurance has to provide you with a brand new refrigerator, not one that has been depreciated to a 10-year use. Must be a minimum of 12 months. You can't get in and out of policies. You have to have a policy that this is, we're talking about the association. If the premium is financed, the lender must review a copy of the agreement and confirm timely payments. Minimum coverage by the association for the structures in the community must be at least 100% of the replacement cost. And until yesterday, when we updated our slides and were finalized these things, there was a period there. But the insurance companies have convinced Fannie and Freddie that we should not have to replace a 12-year-old roof with an expected life of, I guess they're up to 25 years. So let's call it a 50% value. We should not have to replace a value, actual cash value roof that's 50% of the new cost. We should be able to pay actual cash value for the roof. And it took a while, but as of the spring of this year, Fannie and Freddie do no longer require that you have full replacement cost insurance for your roofs. Now, think about that, folks. You have a casualty, you have a fire, and the roof, in my example, is 50% depreciated. Who's going to pay the 50% difference between the cost that you get from the insurance company and the cost to put on the new roof? The association is, the homeowners are. The maximum amount of the deductible is a huge issue with Fannie and Freddie. It's based on the total insurable value of the property. The next slide shows you And we have clients that do not qualify for Fannie and Freddie because of this.
Yeah.
The total
And
amount of the deductible cannot exceed 5% of the coverage on the buildings or $50,000 per unit if a per unit deductible applies. Well, as I said earlier, a lot of them are at 50, and we've got some that are in excess of that. So in the example, 200 units, $30 million value, $50,000 per unit. We have $10 million, 5% is $1.5 million. Building is not eligible. Yeah. Unless the HO6 policies, and I don't mean to laugh, it's just how complex it then becomes. If everybody in the association has an HO6 policy, which isn't required, and every one of those HO6 policies includes water damage, and you can provide that information to Fannie Mae, then you can overcome the fact that you don't qualify. You want your HO6, we've already talked about, to cover the deductible that's assessed to you. Also, it's also called loss assessment insurance. And then Bill mentioned it in the trends, and this is a big trend.
Yeah.
The association can buy insurance to buy down the deductible so that it doesn't exceed the 5%. I've got to tell you that there is a blacklist. There is a confidential list that isn't so confidential, where Fannie lists the associations that just aren't eligible. And it is increasing. I can't remember the last time, but let's say it's increasing by close to 1,000 associations a month, where the project is no longer eligible for Fannie Mae and Freddie Mac financing. What does that mean to you individually and buyers and sellers generally? Is traditional lenders who take the loan they made to you and they sell it to Fannie or Freddie at a discount, but that gives them more money then to loan. Fannie and Freddie won't buy those loans. So you have to go to non-traditional lenders, which go on TV. They almost feel like traditional lenders at this point, right? But you pay more. Right. So that is a big issue with high-rise condominiums. It's a huge issue locally and nationwide.
I'm so glad that you made that point, because I know we'll get the question of, do we have to follow all of these Fannie Mae and Freddie Mac requirements? Technically, no. Okay. There's not a law that's mandating it. But if you want to be able to finance purchases, refinances, etc., with traditional lenders, like mortgage from Bank of America, then you're going to have to comply with these underwriting requirements. Otherwise, you're going to be looking at non-traditional sources of lending.
And I think we all should say at this point that after the Champlain Towers tragedy in Florida, Fannie and Freddie both came out with extensive questionnaires, applications, yes. I don't know, questionnaires.
Yep.
As much as 11 pages long, folks. And it gets into, when was the last time you did this? When was the last time you had a special assessment? When was the last time the building was inspected by an engineer? Do you have any plans? Have you received any notices of noncompliance? And it goes on and on and on. And insurance companies have very similar questionnaires now. And when it comes to insurance companies, and this is such common sense, but it never happened, they want to know exactly what they're insuring, what they're getting themselves into, before they either agree to insure you or they set the premium. Bill's point is, do you have to comply with Fannie and Freddie, meaning the association filling out the forms? The answer is no. But if you don't, then you've taken out of the potential sources of financing your traditional lenders.
Last slide on property is a little bit of a recap. Going back to water damage, we know it's not part of the fire and extended coverage required by the Condominium Act, but you should have it anyways. It covers these sudden and accidental pipe breaks or appliance overflows. It does not cover maintenance issues, deferred maintenance issues, these slow, long-term leaks or wear and tear. And the last point we'll make, which we haven't touched on yet, it's not, coverage isn't determined by fault. It's, did it happen? is it covered? There may be fault involved, and there may be a subrogation claim where the property insurance carrier pays out the claim and then pursues someone that was negligent that caused something. But what we're not concerned about fault. And I think a lot of our clients get wrapped up in the fault issue rather than just focusing on, do we have this type of coverage, and is it, a sudden and accidental or appliance overflow, etc.
And on that point, Bill, yeah, you're my upstairs neighbor.
Yep.
And I get a call from the building or a neighbor saying, "Hey, I don't think this is normal, George, but there's water flowing out your front door." And I go home and there's a deluge from your unit.
I'm sorry.
And it turns out that your washing machine hose blew off the back of your washing machine and damaged the unit below. I'm saying, "Well, Bill, you got to take care of this." And Bill says, "No, I don't," because I know Bill. "No, I don't." And I say, "Yes, you are. It's your water. It shouldn't have happened." And Bill, being the extremely talented lawyer that he is, he says, "I didn't do anything wrong." And I shout back, "Neither did I." Well, Bill says, "But that's the most important thing here as to who pays for this. I'm not responsible for the damage that water caused to your unit unless I was negligent." Well, of course you were negligent. It blew off. And Bill says, "So what you're saying is I have to inspect my hoses every day to make sure they're not going to blow off. And if I'm caught off guard, I say yes." To which Bill says, "Do you do that?" In order for Bill to be liable, and this is true in any water damage scenario, there's a saying about something happens. Well, there's another saying, water happens. And unless the person who is the source was negligent, I have to fix my own damage because he didn't do anything wrong. And I can say neither did I until the cows come home. But that's the key thing. And that's why you want an HO6 policy for individual units and water damage coverage for the association. But boy, folks, that is what really sets people off when that, and then I have to pay the water damage deductible if there's water damage coverage in the association's policy.
Right. That leads me to, this is another linked article that goes into detail on this very issue. So it's very helpful. George wrote this, I don't know, 120 years ago. It's still very relevant today. So please review that when you have a chance. Enough about property insurance, George. Real quick on liability insurance.
Real quick, liability insurance, like your homeowner's policy, covers people who get hurt on your property. So where we're talking here is in the unit, but we also have, from the beginning of this presentation, the Georgia Condominium Act requires the association to have liability insurance on the common property. The minimum is $1 million per occurrence with a $2 million aggregate. Now, back in 1976, 75, when the Georgia Condominium Act was written, $1 million per occurrence and $2 million aggregate was unbelievable.
Million was a million back then.
Yeah, $1 million doesn't go as far as it used to, as we all know. So most associations, well, not most, let's say approaching 50% of the associations have the minimum, but then have an additional policy called an umbrella or excess liability policy. And Bill talked about 2, 4, 5, 6, 10. We've got one association that has a $40 million umbrella with basic and then that. And that just says once you exhaust your basic coverage, then the umbrella comes in and covers the remainder from your $1 million or $2 million up to whatever your limit of your umbrella policy is. So again, it's covering people who get hurt, bodily injury or property damage that occurs on the common property for which the association was responsible. It's still negligent. Just because you got hurt on the common property, think about personal injury claims at the Kroger store where somebody slips and falls. Just because they slip and fall doesn't mean they're automatically liable. They had to have been negligent. Same thing here.
All right, last major policy that we want to talk about before we get close with our checklist is D&O insurance. This is very important for all community associations, whether you're a common law HOA, DOA, condominium. This is the coverage for wrongful act or wrongful or bad decisions of the association and its board of directors and officers. It's a type of liability insurance for the decisions you make or don't make as directors and officers. If you don't have it, get it immediately. Very important. And with that, make sure that the directors are covered by it, the officers, the property manager, any committee members, volunteers, agents, spouses. The reason why we do that is so that, for example, you tow someone's vehicle, okay? If the director calls in the tow, and then the homeowner sues for wrongful towing, then you're likely to have coverage. What if the director texts the property manager or the head of the buildings and grounds committee and says, call a tow truck, and they do it, and they're not covered under the D&O policy? We might have a problem. So we want a very expansive definition of who's insured under this policy. We also want to make sure that we have broad coverage for the types of claims that community associations see that maybe other types of nonprofits don't see. We're talking about fair housing or other discrimination claims, code violations, non-monetary relief. In other words, the association's getting sued for and the plaintiff seeking only an injunction or declaratory relief, not money. We want to make sure that that's covered. When there's a breach of contract claim, or when there's, which would be common in associations because there's the argument that you breached the covenants, or when there's a claim for punitive damages. That list are common exclusions in a lot of D&O policies. So we want to make sure that our policy includes that coverage. So broad definition of who's covered and what types of claims are covered. Very important.
Hey, Bill, on that, before we get into the next slide, knowing who to report to is a common issue where someone makes a claim against the association and they may allege bodily injury or property damage, but they say that that occurred because of the bad decision or indecision of the board of directors. Why don't you talk about reporting claims when there may be property claims or otherwise, but they're also saying that the board made a bad decision?
The 2 points I'll make on that is generally D&O is not going to pay for property damage or personal injury, but when in doubt, err on the side of caution, submit the claim to both your D&O and your liability carrier, and then you'll have an answer. Okay. Real quick, under D&O, it's a claims made policy. So, when you're changing D&O companies, you want to make sure you purchase what they call tail insurance. It's for extending reporting so that there's no gap in between the coverage. And we talked about this earlier. We want to make sure that we timely report any sort of allegations or claims or incidents that could become lawsuits while that policy is in effect. And then we have an article on D&O that we've linked to, another helpful one. And then I know we're about out of time, but we wanted to leave you with our insurance tips. This applies to everyone. 1, review your coverage annually. The agencies that specialize in community association insurance offer this free of charge to both their customers and other associations that are not their customers. They will review your coverage, make recommendations, take advantage of that, and take advantage of it often. Number two, carefully complete your applications. When you're sent something to sign by your agent, you need to verify that it's accurate and complete so that there's not an issue down the road regarding coverage if there's a loss or an incident. Number three, update your carriers when you do some sort of big maintenance project or repair or replacement work, because it might help your premium or help keep coverage. So keep them in the loop when you're doing things like installing a new roof. Number four, make sure that you're keeping an inventory of your assets and verifying the actual cost to rebuild those assets on a regular basis. You know, for example, if you've expanded or renovated a clubhouse or a pool house, what, is the carrier aware of it and the cost to actually replace it? Number five, we've talked about this a lot lately. Educate your owners on what coverage you have and don't have, and provide copies of the policies with them so that they can get their own coverage. And then last, don't purchase policies from auto insurance carriers, generally speaking. I'm not going to name names of the bad guys, so to speak, but I will tell you who we find to be the best carriers in the community association industry. And that would be CNA Insurance, CAU Insurance, Travelers Insurance, Philadelphia, Great American. Those are the main ones. It's not to say that they're the only ones, but those are the main ones. Where we've had issues is where our clients have gone to the big advertisers on TV that you see during college football or Super Bowl, etc. They tend to be difficult to deal with, deny claims, have a lot of exclusions and excuses, and are not familiar with how community associations are operated and what kind of losses that they see. So a lot of times the policies they write aren't worth the paper that they're written on. With that, I think we're done for today. Jocelyn, we've taken the questions throughout. Did you want to say anything before we sign off?
I do have two last questions in the chat.
Sure.
One of the questions being, our community is a fee simple townhome, but we have a master policy that refers to condominium, and our personal policies are all HO6 policies. Is this correct?
That's a really specific question.
Yeah.
That's based on your documents, and it's not something that we could answer in a general way.
Yeah. Sometimes the condo form policies are used for attached dwelling communities that aren't technically condominiums. But George is right. We would need to look at the policy, the governing documents, and to get advice on that.
Okay. And last question. Does D&O apply if someone files a complaint under SB 406?
Where are they filing the complaint? Are we talking about what I'll call a regulatory complaint, where they're filing with the Secretary of State under their new dispute process? Or are we talking about where they file a lawsuit in court for alleged violations of SB 406? You probably don't know the answer to that yet. And what we'll say, and George, you can add, is if the claim is in court, then we will hope that there will be coverage. And I think it's more likely. Whether or not they're going to provide coverage for these, what we'll call the regulatory type claims with the Secretary of State, remains to be seen.
I agree.
Yeah.
And that
Were
is
there
all.
any other questions, Jocelyn?
Nope, that was all the questions. We actually got through all of them.
Great.
Great. Well, thank you so much, everyone. We
Yes.
hope you enjoyed our class. I know it was a lot. Like Jocelyn said, she is going to send out the presentation. We'll also send a link to the CAI of Georgia membership directory that has a list of insurance agencies. It also has lists of landscaping vendors, engineers, and all sorts of other professionals that provide services to the community association industry. So you can check that out. If you enjoyed our class, we'd love to know. Please leave us a Google review. We greatly appreciate it. Of course, the reviews we tend to get are from angry homeowners that are typically adverse to the association. So it's always helpful to hear from our positive feedback from our clients. So thank you so much,
Thanks, everybody.
and hope everybody has a good rest of the week. Thank
Take
you.
care.
Bye-bye.